Welcome back to the Deep Dive. Today, we are taking a scalpel to an investment that, has long been a favorite for income-focused portfolios. STAG Industrial, Inc.,
Mm.
STAG.
Mm.
For the seasoned investor, for you, the listener, who rightly looks past just the superficial yield the industrial real estate investment trust, or REIT, sector is, well, it's undergoing a profound bifurcation.
It really is. It's a dramatic split between those with truly irreplaceable assets and those whose assets are fundamentally a commodity.
And that's the critical lens we need today, isn't it? Our mission is to move beyond that traditional income story of STAG
Yeah.
and subject their cash flows to a deep structural stress test.
Yeah, we're scrutinizing the durability of their whole aggregator business model. We're putting it up against what looks like a perfect storm of macroeconomic and supply-side headwinds that the market has arguably not fully priced in.
And we're starting with a pretty provocative conclusion that I think challenges the entire pitch.
Yeah.
The analysis suggests that STAG, especially right now in this cycle, represents a classic value trap.
It absolutely does. That aggregator model, which was, look, it was brilliant during the era of zero interest rate policy.
It worked perfectly. Yes.
It was a money printing machine. But now it seems structurally fragile because the whole external environment that fueled it it's vanished.
It's fragile because, as you say, that model just fundamentally lacks the genuine pricing power that comes from true scarcity.
Exactly. Our framework today is going to rely heavily on contrasting two worlds, the infill versus unconstrained model. This distinction, which we're borrowing from analysis of premium peers like Rexford Industrial, it really helps us understand where value is created versus where value is simply aggregated.
And we'll also be using some critical real-time leading indicators, specifically data from the less-than-truckload, the LTL shipping sector.
The canaries in the coal mine.
Exactly. To gauge the true current health of physical industrial demand. We need to see if the engine that drove STAG's whole decade of success is, still capable of generating the growth it needs to outrun obsolescence and rising costs.
Precisely. So let's start with the macro environment, because the tailwinds of the past decade, they haven't just slowed, they've actively reversed.
Okay, let's unpack this. We have to start with this massive tectonic plate shift happening in the global economy.
Yeah.
This move away from the environment that created STAG's opportunity. We're calling this Section 9, macroeconomic regime change, the death of the tailwinds.
A fitting title.
And the first point here is the collapse of the inventory supercycle.
This is really where we have to lay the foundation. From, say, the early stages of the pandemic in 2020 through early 2023, industrial real estate experienced this. I mean, it was an anomalous, historic demand shock.
Right. Companies worldwide just instantly pivoted their supply chain strategy. They moved away from that lean, efficient, just-in-time model.
Yeah, that JIT model went out the window overnight.
They were scrambling. Instead of JIT, they were in total panic mode, adopting just-in-case inventory management. They were leasing every available square foot of warehouse space they could find.
Often in secondary and tertiary markets, too. Just anywhere to hold buffer stock, trying to secure themselves against future supply chain chaos.
And that anomalous boom, driven by fear and, ultra-cheap capital, that was the rising tide that lifted all the industrial real estate boats, wasn't it?
It lifted everything, regardless of quality or location. It completely masked the quality distinctions. I mean, it didn't matter whether you had a modern high-spec distribution center near a major port or, an older, functionally challenged Class B warehouse 50 miles outside a core city.
The exact kind of asset STAG typically aggregates.
Exactly. It didn't matter. Demand was just so immense that all space was valuable.
So now, the sources we've looked at confirm this cycle has peaked and is fully unwound. In fact, we're seeing the opposite, a massive inventory rationalization effort.
And this is a totally rational, predictable response to the change in the cost of capital. I mean, in a high interest rate environment, holding excessive inventory is just incredibly expensive.
Every dollar tied up in buffer stock is costing you, 5, 6, 7%?
At least. So logistics managers and CFOs are now aggressively trying to shrink their inventory exposure just to free up cash. And this translates directly and immediately into less urgent demand for warehouse space, particularly that overflow space.
And crucially, we don't have to wait for STAG's leasing reports to see this slowdown. We can look at the transportation sector, which is the precursor, especially less than truckload or LTL trucking.
LTL carriers are the absolute canary in the coal mine for industrial health. They handle that highly granular day-to-day movement of manufactured goods, parts, inputs.
All the small stuff.
Right. So when the major LTL carriers, think TFI International or Old Dominion Freight Line, when they report persistent softness, sliding profits, revenue dips, and they openly cite a lack of the industrial rebound everyone was forecasting.
That's a real signal.
That signals a genuine and systemic reduction in the velocity and volume of physical goods moving through the economy.
And if the goods aren't moving urgently, then the urgency for tenants to expand their footprints, or, more critically for STAG, to maintain their non-core satellite footprints, it just vanishes.
Precisely. And this is STAG's specific Achilles heel. Their portfolio is so heavily weighted toward these secondary and satellite facilities. In the boom, tenants expanded outward into these markets because they just needed any roof over their heads.
Right.
But in a normalization phase, the CFOs are demanding efficiency. And the first cost savings they find is consolidating back to their core distribution hubs to cut down on those critical transportation and labor costs.
So STAG's Class B assets, those overflow warehouses, are the most vulnerable.
They're the first to feel the chill. The inventory hoarding tailwind is dead, and now these assets have to compete purely on their often questionable merits against a wall of brand new supply.
Let's link that demand collapse to the second headwind, which is arguably the most structural one, the higher for longer rate reality. This completely changes the fundamental math of real estate.
Real estate is simple at its core. It's a spread business. You borrow money at cost X, and you buy an asset that yields Y. If Y is greater than X, you create value. You get that positive leverage.
And the ZRP era was perfect for that.
Yeah.
STAG was acquiring assets yielding 6–7% cap rates while borrowing debt at 3 or 4%.
Yeah, they were pocketing a 200 to 400 basis point spread, all funded by that cheap money. That massive positive spread was the absolute lifeblood of their aggregation growth model.
But now we're in the era of cost of capital inversion. The math is broken. We have high 10-year treasury yields. Corporate borrowing costs are up. So let's talk specifics on their WACC, their weighted average cost of capital.
Okay, so STAG's WACC is the minimum return the company has to generate to satisfy both its debt holders and its equity holders. With the cost of debt now firmly in the 5.5% to 6% range, and factoring in the cost of equity, which is pressured higher by the market, our conservative analysis suggests STAG's all-in WACC is now firmly in that 5.5% to 6% range.
Maybe even higher?
Potentially even higher, yeah.
So this is the core problem for an aggregator. If their WACC is, let's say, 5.8%, they have to acquire properties yielding substantially more than that just to justify the transaction and create any real value.
Exactly. And look at their Q3 2025 activity. They acquired buildings for about $101.5 million at a reported cash cap rate of 6.6%. Now, on the surface, 6.6% looks positive against a 5.8% WACC.
Yeah, looks like an 80 basis point spread.
But that spread is totally illusory. Once you factor in transaction, friction due diligence, closing costs, commissions, and the inevitable initial capex you need for older assets, that spread is near zero. Or more likely, it's outright negative.
So the growth engine, the external volume aggregation that defined their success, has effectively seized up. They can't aggressively pursue volume without diluting shareholder value.
Which forces them to pivot to internal growth, a source of growth that, as we'll see, is structurally capped.
And that takes us to the second impact here, the severe valuation compression, what you call the bond proxy trap.
Right. STAG was prized for its yield stability, which put it in that bond proxy category. But now, that stable yield has to compete directly with risk-free alternatives.
And you can get a 5% risk-free return right now in short-term treasuries. STAG's dividend yield is around 3.9%. Why would any sophisticated investor take a lower, riskier yield in a cyclical asset?
Especially one that needs a ton of capital expenditure to maintain.
Versus a guaranteed, risk-free 5%.
They won't. They absolutely will not. And this competition forces the market to mechanically derate the stock price. The price has to fall until the yield rises to a competitive level, maybe 6 or 7%, just to compensate investors for the risk.
And that derating increases their cost of equity, which hurts their ability to raise capital. It's a vicious cycle.
It's a negative feedback loop, yeah, and it's all driven by duration risk. Because industrial leases are long-term assets, STAG's valuation is just mathematically sensitive to the discount rate. It's a prisoner of the yield curve. That bond proxy status is now a liability, not an asset.
Okay, so we've established demand is softening and the cost of capital is prohibitive. Now, let's combine those with the final macro killer, The supply shock in unconstrained markets. This is where we bring in that infill versus unconstrained framework.
Right, and this framework is absolutely fundamental to understanding quality in industrial real estate.
So what's the distinction?
It's simple. Scarcity.
Hmm.
Infill markets like Southern California's Inland Empire or Northern New Jersey, they're land constrained. Zoning is tough, land is minimal. Scarcity drives rent growth because new supply just can't easily enter the market.
And STAG doesn't primarily operate in those prime infill markets.
Correct. STAG's markets, Dallas, Atlanta, Columbus, Chicago, are defined by high supply elasticity. And what we mean by supply elasticity is just the speed and ease with which new competing product can be built.
So break that down for our listener. What does high supply elasticity mean in practice?
It means negligible barriers to new supply. Developers follow the path of least resistance. Cheap, flat land, and permissive zoning. So if STAG, as the existing landlord, tries to jack up rents on their facilities, a developer will just go pave the adjacent cornfield and build a brand new facility for a comparable price.
So this infinite potential supply acts as a permanent ceiling on their pricing power.
It's a structural ceiling. They're selling a commodity product.
And the pipeline of that commodity is massive right now. The construction starts from the 2021-2022 euphoria are all hitting the market now in 2024 and 2025.
A massive delivery wave, yeah. These unconstrained markets are being absolutely flooded just as demand is pulling back. The timing is catastrophic for owners of older assets.
I mean, even historically tight markets like the Inland Empire, which usually has super low vacancy, saw its vacancy surge to near 8% just because of this supply wave.
And if a market like that, with some constraints, is facing 8% vacancy, what do you think is going to happen in these truly secondary, highly elastic markets?
Double digits easily.
They will likely face double-digit vacancy rates,
Yeah.
10%, 12%, maybe even higher. And this puts STAG's older, middle-aged Class B assets at a severe competitive disadvantage. If you're a tenant and your lease is up, you face a very clear choice.
Stay in the 20-year-old STAG building and accept a 25% rent hike.
Or move down the road to a brand new high-spec facility that's offering you a heavily incentivized comparable rent. The new inventory is the ultimate substitute good.
And that supply dynamic, it fundamentally caps STAG's rental pricing power. The rent is determined by replacement cost, not by scarcity.
That is the structural difference. Infill REITs extract value from scarcity. STAG is trying to extract value from a commodity, which is a losing game when new supply is everywhere.
Well, that sets the stage perfectly for a deep dive into the business model itself. Let's move to Section 2, where we drill down into the structural weaknesses of this aggregation strategy.
Right. Now we're drilling down into the quantitative drag on cash flow. We're focusing on the intrinsic risk profiles baked into the strategy, which, really prioritizes volume over quality.
And the first flaw is this binary risk profile from their single-tenant focus. Now, management correctly touts this impressive diversification, 601 buildings, 41 states, but for each building, the risk is it's binary.
It is. It's either 100% leased and making money, or it's 0% leased and it's a cash drain.
A huge cash drain.
And while that diversification helps mitigate, a fire at one building, the key problem is economic correlation. In a broad logistics or manufacturing downturn, exactly what the LTL sector is signaling, the binary outcomes in secondary markets like Detroit, Cleveland, and Greenville all tend to converge towards zero.
A broad recession hits all those linked regional hubs at the same time.
Simultaneously. Which leads us to what is so often undermodeled by investors. The punitive cost of vacancy for a big single-tenant asset in these markets. We call these the dark carry costs.
This is when the cash flow just reverses instantly and dramatically.
The revenue stream stops, but the fixed costs don't. The landlord immediately starts footing the bill for substantial operational costs that directly and materially erode the net operating income, the NOI.
So give us a concrete example of that financial drag.
Okay, let's imagine one of STAG's median-sized assets. A 350,000 square foot warehouse in a secondary market, say Indianapolis. When the tenant leaves, STAG is immediately on the hook for property taxes.
Which aren't cheap.
No. Depending on the state, that can easily be $40,000 to $60,000 a month for an asset that size. Then you add substantial insurance premiums, which have skyrocketed recently, utilities just to keep the lights on, and security to prevent vandalism.
So even with zero revenue, that one empty building is costing the company 6 figures in negative cash flow per quarter. just to hold it.
Exactly. It turns a zero revenue asset into a major measurable drain on the entire portfolio's cash flow. It's a punitive cost, especially since releasing these large, older facilities in a supply glut is slow. It can take 12 to 24 months.
And even if they do find a new tenant, that leads straight into the second problem, the high frictional cost, the CapEx shock. The cost of convincing a tenant to move into an older building when there's a brand new one down the street.
That is the tax on obsolescence that the aggregator model constantly has to pay. To make an older asset compete with new Class A supply, STAG has to offer significant tenant improvement or TI allowances. And these are multi-million-dollar upfront capital outlays that just kill the effective yield.
How significant are we talking for these TIs?
It's common for landlords to have to offer $10 to $20 per square foot in allowances to fit out the space for a new tenant, especially if the facility needs updates. So think about that same 350,000 square foot building. If STAG has to spend $15 a square foot,
That's over $5 million.
it's $5.25 million in upfront CapEx just to secure a 10-year lease.
That's a staggering upfront investment. It completely erodes the initial cap rate. And the sources confirm STAG reported paying about $1.10 per square foot in TIs on new leases in Q3 2025.
And even at that lower reported number, these are substantial capital events. When you divide that $1.10 per square foot over the life of the lease, plus all the CapEx for maintenance roofs, paving, HVAC, it dramatically reduces the effective yield over a full cycle. This is often obscured by simple metrics like cash NOI, which conveniently exclude these big capital expenditures.
So it gives a misleadingly rosy picture. It sounds like the value STAG captures on acquisition is just constantly being bled out through maintenance and retenanting costs.
That's the core takeaway. The model bought assets on the cheap, but structurally, it constantly has to pay to refurbish and maintain them against intense competition, which erodes that initial positive spread.
This brings us right back to the commodity trap and pricing power, that concept of supply elasticity versus scarcity.
If the product is a commodity, 4 walls and a roof without a unique, irreplaceable location, then its price is dictated by its most efficient competitor.
Which is the new building across the field.
Exactly. If STAG tries to raise rents significantly above the cost of new construction, developers will simply build a perfect substitute.
So STAG lacks true pricing power in the economic sense. Their rents can only rise as fast as construction costs and inflation allow. They're not driven by scarcity.
Precisely. If construction costs flatten out, STAG's rental growth potential stalls completely. The only way they get a big rent bump is if a property is severely under-rented, which just gives the tenant a huge incentive to move to a superior brand new space when the lease is up.
And this structural limitation is compounded by functional obsolescence. You mentioned these middle-aged buildings 15 to 30 years old. Why can't they compete with modern logistics?
Because the modern logistics game has moved from simple storage to high-tech automation. We've gone from, filing cabinets to data centers, architecturally speaking. Modern tenants demand 36 to 40-foot clear heights to maximize cubic storage. They need super flat floors for robotics. They need massive power capacity for EV charging fleets and advanced machinery.
And you can't just easily update those features.
You can't just raise the roof of an old concrete tilt-up warehouse. Retrofitting is often economically unviable compared to just building new. This means STAG's older portfolio is structurally unsuited for the highest value, most creditworthy tenants.
Which creates a specific kind of tenant selection bias. Who's left to lease STAG's older, lower-spec buildings?
They filter for the price-sensitive, lower-margin businesses. Regional distributors, third-party logistics firms with less complex needs, light manufacturers who can't afford Class A space. And this is a crucial credit-negative selection bias for the portfolio.
So STAG's tenant base represents the weaker hand of the economy.
Exactly. If we hit a recession, this is the group that's first to face margin compression, layoffs, and bankruptcy risk, which just accelerates the vacancy problem.
Let's apply a classic critical framework to this. Section C, a competitive mode analysis using Porter's 5 forces. Management always talks about their deal flow and proprietary data, but how does their segment really stand out?
Those narratives focus on execution, which is secondary to the structural attractiveness of the market you're in. We have to look at the total cost of logistics. For a sophisticated tenant, rent is maybe 4% to 6% of their total cost.
Right.
The overwhelmingly dominant cost, 45% to 70%, is transportation, driver wages, fuel, drayage.
So the sophisticated tenant is totally rational to pay a massive rent premium, say 100% higher rent, for an infill location if it saves them 20% on trucking costs.
Absolutely. The rent premium is completely funded by the transportation savings, and this exposes STAG's fundamental drayage disadvantage. Their exurban secondary market locations mean higher transportation costs for the tenant. The low rent they offer often proves to be a false economy.
Which means sophisticated investment-grade tenants will rationally abandon that remote B space for more expensive but more efficient A space closer to the core.
And again, STAG is left with the tenants who are less sophisticated or have the lowest throughput needs. So when we apply Porter's analysis to their market segment older, commodity assets, and elastic markets, it paints a deeply unattractive picture.
Okay, let's run through the forces. Define that weakness precisely.
Start with the threat of new entrants. It's high. Barriers to entry are low, land is cheap, zoning is often permissive. Any regional developer with capital can become a competitor overnight.
Okay? Next, the bargaining power of buyers or tenants.
Also high. The product is a commodity, 4 walls and a roof, and critically, there are now tons of substitutes because of the new supply wave. Tenants have immense leverage to demand concessions, free rent, and those high TI allowances.
And finally, the rivalry among existing competitors in that fragmented Class B space.
High. Because the product is commoditized, competition is based almost entirely on price and concessions. This leads to structurally constrained, low margins over the full cycle. The lack of scarcity is the root structural weakness. The company lacks pricing power, the product is aging, and the competitive environment is just brutal.
That transitions us perfectly to the financial structure. If the underlying real estate can't create value through scarcity, then the financials have to be flawless. Let's move on to Section 3. Financial analysis, the constrained balance sheet.
Right, and real estate investing, especially in a REIT, is all about intelligent capital allocation. STAG's historical model was driven by a financial formula that is now, well, it's mathematically broken. We're in the negative leverage trap.
So we have to contrast the new math with the old math. In the past, STAG's WOCC was low, maybe 3.5% to 4.0%. They were buying assets at 6.5% to 7.0% cap rates.
Yeah, that 250 to 350 basis point spread, financed with cheap debt, was pure value creation. They could leverage up, buy more volume, and instantly increase FFO per share.
But the new math is a whole different ballgame.
Completely. The marginal cost of new unsecured debt is around 5.5% to 6%. We established the total WACC is hovering in that same range. So even when STAG reports buying buildings at a 6.6% cash cap rate, the spread over their WACC is virtually non-existent once you account for transaction costs.
So let's put a number on that friction. If they buy a $10 million asset at a 6.6% cap, that's $660,000 in NOI. If the WACC is 5.8%, the cost of capital is $580,000. So the gross spread is $80,000.
Right. But that same asset needs $50,000 in transaction costs and probably $100,000 in immediate capex. You have to amortize that $150,000 cost over the first few years, and that quickly pushes the effective return way below the WACC.
That's the inevitable outcome then. STAG cannot aggressively pursue its historical volume aggregation strategy without actively diluting shareholder value over the long term.
The engine is seized, which forces the company to pivot entirely to internal growth, to rent hikes, which we know are capped by all this new supply hitting the market.
And there's a crucial management incentive critique here we have to highlight. The 2024 annual bonus structure ties 10% of management compensation directly to acquisition volume.
This is a huge problem. This compensation structure incentivizes growth for growth's sake, regardless of the quality or the return on invested capital. When the positive spread is gone, but management is still rewarded for volume, it encourages deals that are only marginally accretive or, even worse, outright dilutive on a full-cycle ROIC basis.
So they're incentivized to just churn the portfolio, buy assets to hit targets.
Exactly, which further challenges the overall quality and ROIC profile of the company.
Okay, let's scrutinize that return on invested capital, ROIC, next. This is the ultimate metric for critical investors because it separates real value creation from just, FFO growth by taking on more debt.
Right. True value creation only happens when your ROIC is consistently higher than your WACC. When we look at STAG's historical performance, our analysis shows their return on invested capital is approximately 4.6%.
How does that compare to the industry leaders, the infill REITs?
It's significantly lower. Top-tier, scarcity-driven peers are typically generating ROICs closer to 5.7% or even higher. It tells you that for every dollar STAG puts into buying or improving buildings, they're generating a lower rate of return than their best competitors.
And crucially, that 4.6% ROIC profile is structurally capped. Why can't they improve this number dramatically on lease rollovers even if they get a 30% rent increase on paper.
Because of the supply elasticity we talked about, STAG's potential rents are fundamentally limited by the cost of new supply by replacement costs.
Mhm.
They can't experience the massive embedded rent growth that infill REITs see, where rents might double on a rollover because of the intense scarcity of the land.
So if your revenue growth is fundamentally limited, your ROIC profile is also structurally limited to being mediocre. It can expand dramatically.
It struggles to, especially as the fixed cost, base operating expenses, property taxes, CapEx all continues to rise with inflation. This structural cap means that STAG's true long-term growth rate is probably limited to inflation plus maybe 1% if they execute flawlessly.
Okay, now let's talk about the dividend, the monthly dividend, the thing that draws in so many retail investors, but which we see as a capital allocation straitjacket,
Yeah.
the dividend payout constraint.
The monthly nature of it is marketed as safety and reliability, but it's fundamentally a rigid, high-percentage payout of their operating cash flow. STAG pays out a huge portion of its afforded funds from operations, or AFFO, to maintain that annualized dividend of $1.49.
So after paying that dividend, what's the company actually left with for internal use?
Very little. The company's retained free cash flow, the cash left over after dividends and necessary maintenance CapEx, is only about $100 million a year.
Which is nothing.
It's grossly insufficient to self-fund any significant growth, and it's certainly not enough to fund the large necessary CapEx projects required to upgrade and maintain this aging, middle-aged portfolio of hundreds of buildings.
And that insufficient retained cash flow leads to what you call the hamster wheel effect, this perpetual capital dependency.
STAG is trapped. They need to show growth to satisfy the market, but they pay out too much cash to fund it internally. So they are perpetually forced to issue equity through their at-the-market program or tap the debt markets just to fund necessary maintenance, upgrades, and to maintain the illusion of growth.
This means constant dilution for shareholders.
Especially when capital market terms are unfavorable, which they are right now in a high-rate environment. This dependency is a major liability that undermines long-term value creation.
It's important to note, though, despite these constraints, the balance sheet itself is fine in terms of raw leverage. Net debt to adjusted EBITDA is 5.1x. That's pretty standard for a REIT.
Oh, the balance sheet strength is a mitigating factor, absolutely. They aren't going bankrupt tomorrow. The constraint isn't the availability of capital, it's the cost of that capital and the pressure the dividend puts on flexible deployment. The dividend is safe for now, but it comes at the steep cost of long-term strategic flexibility and asset quality.
That sets up our final discussion perfectly, how the market is pricing these deep structural weaknesses, or, more accurately, how it's failing to price them. Section 4. Valuation, narratives, and investment verdict.
Yeah, and we need to address the most common mistake investors make when they look at STAG, seeing its lower multiple as cheap. The stock typically trades at 15 to 16 times price to FFO, which looks cheap compared to premium peers, Rexford at 18x, Prolege is closer to 22x. This is the valuation disconnect, the cheapness fallacy.
So the critical investor has to argue that this discount isn't some temporary glitch. It's structural and it's warranted. You're basically arguing that 15x PFFO on STAG's cash flow is actually more expensive than 18x on Rexford's. Justify that for me.
It comes down entirely to a cash flow quality adjustment. STAG's cash flow has a high probability of growing very slowly at the rate of inflation, maybe 2% to 3% a year, because its rents are capped by new supply.
Right.
Premium peers, because of that embedded scarcity in their land-constrained markets, have a high probability of seeing their cash flow growth accelerate. It could potentially double over the next decade.
So you pay a high multiple for high-quality accelerating growth, and you should only pay a low multiple for low-quality stagnating growth. The discount STAG carries isn't a bargain. It's an earned penalty for structural mediocrity.
And this structural overvaluation is really crystallized by the implied cap rate overvaluation, the disconnect between public and private pricing.
Okay, define that clearly for us.
The public market, when it prices STAG at 16x FFO, is implicitly valuing STAG's entire portfolio at roughly a 5.8% implied cap rate. This means the public investor is willing to accept a 5.8% gross yield. However, private equity buyers, sophisticated investors for whom real estate is an operational leveraged business for comparable Class B secondary market assets, they are demanding significantly higher yields, typically in the 6.5% to 7.5% range, to get adequate risk compensation in this high-rate environment.
So the conclusion is pretty potent. The public market is valuing STAG's assets more richly than the private market would. The stock is likely trading at a material premium to its true net asset value, its NAV.
Meaning, if STAG tried to sell a large chunk of its portfolio today, it would likely get prices lower than what the current stock price implies. It's a poor value proposition because the stock is being valued using coastal market assumptions on secondary market assets.
Now, let's critically review the primary narratives management uses to court investors. These often serve to obscure these flaws. Let's start with narrative 1, secondary market stability. Management claims secondary markets are the tortoise that doesn't bust as low as the coastal hare.
Right, the stability argument. The counter thesis is that in the current unique supply shock environment, secondary markets are actually more volatile to the downside, not less. The previous stability was a function of disciplined supply. Now, because there are no natural barriers to entry, supply can rapidly overshoot demand.
And when supply rapidly overshoots demand, what happens to rents?
They can collapse, and quickly, because tenants have infinite choices of new, better product. That lack of a natural constraint means stability is a mirage based on old cycles, not current dynamics. The coast may slow, but these elastic secondary markets face a far greater risk of a deep, painful oversupply cycle.
Okay. Narrative 2. Diversification protects the dividend. Management claims owning assets in 40-plus states protects them from regional downturns.
This is a classic example of diversification across correlated assets. A broad domestic recession in logistics doesn't respect state lines. It hits Detroit, Philadelphia, and Greenville all at the same time. Furthermore, this physical sprawl creates severe operational diseconomies of scale.
Operational diseconomies.
Yeah, managing hundreds of small, disparate assets all over the country incurs higher G&A costs and more fragmented property management expenses compared to a peer who owns fewer, larger clustered assets in one dense, high-value zone. It's an operational drag that pressures the margin.
Finally, narrative 3. Onshoring is a tailwind. The idea that bringing manufacturing back to the U.S. will drive demand for STAG's portfolio.
Onshoring is a real tailwind, but it demands a specialized type of real estate that STAG often doesn't have. We're talking gigafactories for EV batteries, massive semiconductor fabs. These require highly customized new facilities with massive infrastructure.
STAG's generic, older portfolio isn't equipped for that high-value manufacturing demand.
It's not. STAG's portfolio will only compete for the lower margin storage and supplier components of this new supply chain, the raw goods storage, which is easily commoditized and highly competitive. The onshoring trend disproportionately benefits Class A build-to-suit developers, not owners of middle-aged Class B inventory.
Let's finish with a crucial data check from the recent Q3 2025 results. We have to acknowledge the positive data points. Core FFO was the other 65 cents. They raised same-store NOI guidance slightly to 3.75%, 4.00%. Those numbers sound strong.
They sound strong, but the devil is in the details, and the details point directly to the structural weakness. They did achieve a 27.2% cash rent change on new leases, which sounds like massive pricing power. Wait, a 27.2% cash rent change? That's a huge mark-to-market capture. How can you argue they lack pricing power when they're getting rent growth like that? That sounds like a powerful tailwind.
That is an excellent challenge.
Yep.
And it brings us to the most critical indicator, the retention rate. STAG's retention rate in Q3 2025 dropped to 63.4%.
Yeah.
That is substantially lower than their typical 70% to 75% range. This is the smoking gun.
So what does that low retention rate tell the critical investor when you put it next to that high rent growth number?
It tells us that tenants are exercising their option to move to new, better supply rather than accepting STAG's rent hikes. They are achieving that fantastic rent bump only from the 2/3 of the tenants who are trapped or can't afford to move.
So the other 37% walked.
The 37% of tenants who vacated found that the economics of moving to a new, higher-spec facility outweigh the cost of staying in the older STAG building. This is the clearest, most immediate evidence that the supply glut is eroding STAG's pricing power and forcing tenants to vote with their feet. The high rent growth is being applied to a shrinking, captive tenant base. That structural weakness seems insurmountable in this environment.
It is, because the solution significantly upgrading the portfolio is capital intensive, and their capital structure is just too constrained.
We have completed the deep dive into STAG Industrial. Let's just synthesize the convergence of the 4 major risk categories we've discussed for our listener.
So in summary, the 4 forces converging on STAG are macro risk, high rates, which caps valuation and stalls the aggregation engine; market risk, the supply glut and freight recession, which weakens demand while flooding their markets; model risk, the broken spread engine, which necessitates perpetual dilution, and asset risk, obsolescence and elasticity, which structurally limits their pricing power.
Our final investment verdict, therefore, is firm. Avoid or sell. The stock is just priced for an overly optimistic scenario, a rapid return to low rates, and a seamless soft landing.
The fundamental law of industrial real estate remains that capital has to flow towards scarcity and high barriers to entry. When premium REITs with truly irreplaceable assets trade at valuations that are even within striking distance of STAGs, there's just no strategic justification for moving down the quality curve into these commodity assets with binary risk.
Here is the provocative final thought we want to leave you with. STAG's monthly dividend is heavily marketed as safety and reliable income. But we've established that the underlying asset value is structurally doomed to erode against inflation and functional obsolescence because of this persistent supply elasticity.
So if the company has to constantly issue equity just to pay for the capex required to maintain the functional viability of its assets, the roofs, the floors, the TIs, then that dividend essentially becomes a return of capital in real terms, not a return on capital.
You're just getting paid back your own eroding investment slowly every month.
Exactly. For the critical investor, true return depends on genuine, sustained pricing power, which STAG structurally lacks.
And that erosion of underlying asset value, masked by the steady monthly check, is the core risk that must be discounted today. That's all for this deep dive. We'll see you next time.